Before we begin, please remember that I am not a licensed financial advisor, and this presentation is for informational and educational purposes only. The information provided in this video does not constitute financial, legal, or tax advice. You should consult with a qualified professional for advice tailored to your individual situation. Your financial decisions are your own, and you should conduct your own research before taking any action. There is a number that secretly rules the lives of more than 65 million American households. It's not a salary. It's not a credit score. It's $13 trillion. That is the total staggering amount of mortgage debt held in the United States. It's a number so vast, so astronomically huge, it feels meaningless. It's a statistic you'd hear on the news and forget 2 seconds later. But what if I told you that buried inside that $13 trillion monster is the story of your life? The story of your money, your future, and the four walls you call home. And more importantly, what if I told you that you're playing a game you don't fully understand? A game where the rules were written by the banks for the banks to ensure they win every single time? You think you bought a house. But you didn't. You bought a loan. The house is just the collateral. For the next 30 years, you're locked into a contract that is mathematically designed to take the maximum amount of your money in the form of interest for the longest possible time. You see, for the first 7, 8, even 10 years of your mortgage, you aren't building equity. You're not paying down your house. You are renting money from the bank. Your monthly payment is little more than a profit check delivered directly to them, while the actual amount you owe on your home barely budges. This isn't some conspiracy theory. It's just math. It's called an amortization schedule, and it's the most brilliant and frankly most brutal financial product ever invented. And over the next 10 parts of this series, we are going to pull back the curtain on the entire system. We are going to demystify the numbers, expose the hidden traps, and arm you with the knowledge you need to turn the single biggest debt of your life into your single greatest asset. This isn't just about understanding your mortgage statement. This is about understanding the very blueprint of wealth in America. It's about taking back control from the lenders and putting yourself in the driver's seat of your own financial destiny. We're going to show you how to stop being a pawn in the bank's game and start making the game work for you. So let's start at the very beginning. What is a mortgage? The simple answer is it's a loan to buy a house. But that's not the real answer. The real answer is that a mortgage is a product. It's a product that a bank manufactures and sells to you, the consumer. And like any product, from a car to a smartphone, it's designed to generate a profit for the company that sells it. The house is irrelevant to the bank. They don't care about your granite countertops or your beautiful backyard. They care about one thing: the predictable long-term stream of interest payments that you have legally promised to give them every single month for the next 360 months. You are their perfect customer. You are legally bound by a massive contract. Your payments are secured by a physical, immovable asset, your home. And the best part? Most customers have no idea how the product they just bought actually works. They just know they have to make a payment by the first of the month. Every single mortgage payment you make is split into 2 main parts. Think of it like a pizza. One slice goes to principal and the other, much larger slice, goes to interest. Principal is the easy part. That's the actual amount of money you borrowed. If you took out a $400,000 loan, your principal is $400,000. Every penny of principal you pay down is a penny of your house that you now actually own. That's called equity. It's the good stuff. It's what makes you wealthy over time. Then there's the other part of the payment: interest. Interest is the fee you pay to the bank for the privilege of borrowing their money. It's the cost of the loan. It is pure 100% profit for the bank. It does absolutely nothing for you. It doesn't pay down your loan. It doesn't build your equity. It is the price of admission to the homeownership club. Now, here is the secret that is hiding in plain sight. You would assume that when you make your monthly payment, it gets split somewhere close to 50-50 between principal and interest, right? That sounds fair. But it's not what happens. Not even close. This is where that brutal little concept of amortization comes into play. Amortization is just a fancy word for the process of paying off a debt over time in regular installments. But the way it's structured is a work of financial genius for the lender. The amortization schedule is front-loaded with interest. This means that in the early years of your loan, your payment is almost entirely interest. The slice of pizza for the bank is enormous, and your little sliver of principal is laughably small. Let's put some real numbers to this, because this is where the blindfold comes off. Let's say you buy a home and take out a $400,000 mortgage for 30 years at a 7% interest rate. Your monthly payment for principal and interest would be about $2,660. You start making those payments feeling proud. You're a homeowner. Let's look at your very first payment. Payment number 1. Out of that $2,660, guess how much goes to paying down your actual loan, the principal? Just $327. $327. The other $2,333? That's interest. Pure profit for the bank. You just sent them a check for over $2,600, and your massive $400,000 debt shrank by only $300. Keeps going like this month after month, year after year. Let's fast forward one full year. You've made 12 payments. You have paid the bank a total of $31,920. You've poured over 30 grand into your home. So, how much of your $400,000 loan have you actually paid off? Less than $4,000. That's it. You've given the bank nearly $32,000, and in return, they've credited you with less than $4,000 in equity. The other $28,000 vanished into thin air. It was the bank's fee. Let's go even further. After 5 full years of on-time payments, you have paid the bank $159,600. A life-changing amount of money. Surely now you've made a serious dent in that loan, right? Wrong. After 5 years and nearly $160,000 in payments, your principal balance has only gone down by $22,000. You still owe $378,000 on your $400,000 loan. $137,000 of your hard-earned dollars went directly to the bank as pure profit. This is the system. It's designed so the bank gets their money first. They face very little risk in the beginning because they collect almost all of their profit up front. If you sell the house or refinance in those first 5 to 7 years, which is what the average American does, the bank has already made a fortune off of you. They win. You move on to a new house and the clock resets. You start all over again on a new 30-year loan, right back in the interest-heavy danger zone. It's a cycle, a debt trap that keeps the average person from ever truly building significant wealth through their home. This isn't to scare you, it's to empower you. Because once you understand the rules of the game, you can start to bend them in your favor. You are not powerless. That amortization schedule is not set in stone. There are ways to attack the principal, accelerate your equity, and save tens or even hundreds of thousands of dollars in interest. You can beat the bank at their own game. And that is exactly what we are going to explore in the rest of this series. You now understand the fundamental problem. You see how the deck is stacked. The question is, what do you do about it? The first thing you do is not what you think. You don't immediately call your bank. You don't start frantically searching for refinancing options. You don't try to find a side hustle tomorrow. The very first thing you do is you change your mind. You have to fundamentally change how you view the piece of paper you signed. That mortgage isn't a key to your dream home. It's a contract for a 30-year financial battle. And for the last however many years you've been fighting blindfolded. The bank, on the other hand, has the entire battle map. They have a detailed, page-by-page, month-by-month playbook of exactly how they are going to extract over $500,000 from you on your $400,000 loan. This playbook has a name. It's called an amortization schedule. You probably received one in the mountain of paperwork you signed at closing. You probably glanced at it, saw a terrifyingly long list of numbers and dates stretching into the distant future, and quickly filed it away, never to be seen again. That is exactly what the bank wants you to do. Because hiding in plain sight on that boring-looking spreadsheet is the secret to their entire business model. It is the blueprint for your financial servitude, but it is also the key to your freedom. Let's pull it out of the filing cabinet and put it under a microscope. Let's go back to our example from part 1, a $400,000 loan at a 7% interest rate for 30 years. Your monthly principal and interest payment is $2,661. 360 payments for 30 years. You know this part. But what happens inside that very first payment? You write that check for $2,661. You feel good. You're a homeowner. You've made your first payment on your asset. But of that money, do you know how much actually went to paying down your $400,000 debt? $328. That's it. The other $2,333? That was pure interest. Vanished into thin air. It was the rental fee. You paid to the bank for borrowing their money for 1 month. You just made a payment of over $2,600, And your massive debt only shrank by the price of a fancy dinner for two. Let's look at payment number 2. You pay another $2,661. This time your principal payment goes up, right? Yes, by a whopping $2. Your principal payment is now $330, and your interest payment is $2,331. This is the con. This is the design. The system is engineered to be brutally, almost sadistically inefficient at the start. It's called front-loaded interest. The bank structures the deal so they get the majority of their profit, the interest first. They take their winnings off the top for years, before you ever get to make a meaningful dent in what you actually owe. Let's fast forward. Let's say you've been a perfect borrower. You've never missed a payment for 5 straight years. 60 payments. You have paid the bank $159,660. You have poured a small fortune into your home. So, after 5 years of diligence, your $400,000 loan must be down to what? $350? $340? No. After paying nearly $160,000, your loan balance has only decreased by $22,000. It's still at $378,000. Over $137,000 of your hard-earned dollars went directly to the bank in interest. You've been running on a financial treadmill for 5 years, sweating and working, only to find you've barely moved an inch. This is the psychological trap of the 30-year mortgage. It creates a sense of hopelessness. People look at their statements after a few years, see the balance has barely budged, and they just resign themselves to the 30-year sentence. They think, well, I guess this is just how it is. I'll just keep making the payment. That resignation, that complacency, is the most profitable customer emotion the banking industry has ever manufactured. But what if you refused to play their game by their rules? What if you understood the mechanics of that amortization schedule so well that you could use it against them? The bank's entire strategy hinges on one thing: keeping your principal balance as high as possible for as long as possible. The interest you pay every single month is calculated based on that principal balance. The higher the balance, the higher the interest payment. So the most powerful, most rebellious, most effective financial move a homeowner can ever make is to attack the principal balance directly. Every single extra dollar you can pay, and I mean every single one, that is designated principal only, is a tiny financial warrior going to battle for you. It does something magical. That extra dollar doesn't just reduce your debt by $1. It reduces your debt by $1, plus all the interest that dollar would have accrued for the rest of the loan's life. Let's go back to that very first payment. You're supposed to pay $328 towards principal. What if, instead, you found an extra $100? You found it by working a few extra hours, selling something you didn't need, whatever. You make a special payment of $100, and you explicitly tell the bank, this is for principal only. What did you just do? You didn't just pay off $100 of your loan. You just vaporized 30 years of future interest payments on that $100. At a 7% interest rate, that single $100 extra payment in month 1 will ultimately save you more than $300 in interest over the life of the loan. You just got a 300% return on your money guaranteed. Find me a stock market investment that can guarantee you that. You can't, but you can do it every single month inside your own mortgage. Now imagine it's not $100. Imagine it's $200 or $500. Imagine you start doing this consistently. You are no longer just a passive participant making a payment. You are an active strategist, waging a targeted campaign against your own debt. You are taking the bank's playbook, their amortization schedule, and you are lighting it on fire. Every time you make an extra principal payment, you are rewriting your own story. You are shortening the timeline. You are reclaiming years of your life and tens, if not hundreds of thousands of dollars of your own money. The bank built a 360-month prison. Extra principal payments are the tunnel you dig to get out early. The question is no longer if you can beat the bank. The question is how aggressively you're willing to fight. The tools are right in front of you. Most people just don't know how to use them. They think it requires a massive inheritance or winning the lottery. Doesn't. It requires a new way of thinking and a clear strategy. We've now identified the enemy's primary weapon, front-loaded interest. And we've identified our primary weapon, targeted principal payments. But knowing you have a weapon and knowing how to use it are two very different things. How do you make these payments correctly so the bank doesn't just apply it to next month's payment? How do you find this extra money without living on ramen noodles for a decade? The common advice of just pay a little extra is lazy and ineffective. There are far more elegant, more powerful, and more strategic ways to dismantle your mortgage from the inside out. It's not about skipping your daily coffee. It's about a series of calculated strikes that the bank never sees coming. And learning how to launch that first strike, that is exactly where we are going next. The first strike isn't a grand, dramatic gesture. It's quiet, it's precise, and its power lies in a single fundamental truth about your mortgage that the bank counts on you never fully understanding. The truth is, your 30-year loan is a 30-year war, but the most decisive battles are all fought in the first 10 years. To win, you have to understand the battlefield. And that battlefield is your amortization schedule. Amortization is just a fancy word for how your loan is paid off over time. But here's the dirty secret. It is brutally, almost criminally front-loaded with interest. Let's take a standard 30-year fixed-rate mortgage on a $400,000 home. Let's say you got a decent rate, 6%. Your monthly principal and interest payment would be about $2,398. Let's call it $2,400 for round numbers. You make that first payment feeling proud. You just paid $2,400 towards your house. Except you didn't. Not even close. Out of that first $2,400 payment, a staggering $2,000, over 83% of it, is pure interest going straight into the bank's pocket. Only $400 actually went to reduce your $400,000 debt. You just wrote a check for $2,400, and your massive debt shrank by the cost of a nice dinner out. The next month is almost the same. And the next. For years, you are essentially just renting money from the bank. Your payments are barely making a dent in what you actually owe. The principal, that giant mountain of debt, remains almost untouched. And as long as it's there, it's a factory that churns out interest, month after month after month. This is the machine you're up against. This is the beast you have to starve. And the first calculated strike is designed to do exactly that. It's deceptively simple. Pay more than you have to. But not just randomly. Strategically. Let's start with the most basic version of this attack. The 13th payment strategy. Once a year you make one extra mortgage payment. You could save up for it, use a tax refund, a work bonus, whatever. One single extra payment. What does that actually do? Using our $400,000 loan example, let's say at the end of the first year, you make one extra payment of $2,400. Now here's the critical part. Because you are already current on your loan, that extra payment doesn't have to fight its way through the wall of interest. With a regular payment, interest gets to eat first. But with an extra payment designated correctly, and we'll get to exactly how to do that, 100% of that $2,400 is a direct impact, precision-guided missile aimed at the principal balance. You didn't just reduce your loan by an extra $2,400. You eliminated the interest that $2,400 would have generated for the next 29 years. You just destroyed a piece of the interest-generating factory. So what's the result of that one simple action, repeated once a year? On that $400,000 loan, you would pay off your mortgage 4 years and 3 months early. More importantly, you would save over $76,000 in interest. Let that sink in. $76,000. That's a luxury car. That's a college fund. That's a life-changing amount of money, reclaimed from the bank by making one extra payment a year. Now let's upgrade the attack. You've probably heard of bi-weekly payments. The pitch is you pay half your mortgage every 2 weeks. It sounds clever, like you're gaming the system with frequency. But the real magic isn't the frequency. It's a Trojan horse. There are 26 two-week periods in a year. By paying half your mortgage 26 times, you end up making 13 full monthly payments instead of 12. You've just tricked yourself into executing the 13th payment strategy. The problem is, many banks and third-party services that set up these bi-weekly plans charge you for the privilege. They'll hit you with a setup fee or a recurring service fee for something you can do yourself for free. Don't pay someone for basic math. The DIY version is far more powerful and puts you in control. Here's how you do it. Take your monthly mortgage payment, that $2,400. Divide it by 12. That gives you $200. Now, simply add that $200 to your mortgage payment every single month. The result is identical to a bi-weekly plan. You've paid one extra month's payment over the course of the year. But you did it on your terms with no fees and without giving a third-party company access to your bank account. You remain in command. Every dollar you can find. A $50 birthday check from your aunt, $200 from selling old furniture online, a $1,000 bonus from work, is no longer just extra money. It is ammunition. Every time you get a windfall, instead of thinking, what can I buy? You start thinking, how much interest can I kill? Sending a $500 extra payment isn't just sending $500. It's a strategic move. You are buying back your future freedom. You are purchasing years of your life. Because that $500 today might save you $1,500 or $2,000 in interest over the life of the loan. It is the single greatest guaranteed return on investment you will ever find. The stock market can crash. Bonds can fluctuate. But wiping out a 6% debt is the same as earning a guaranteed, tax-free 6% return. You cannot lose. This shift in mindset is the entire game. You stop seeing your mortgage as a passive, monthly bill like a water bill or a Netflix subscription. You start seeing it for what it is, an active financial adversary. The monthly statement is not a bill. It's a battle report. And every extra principal payment is a victory. It's a tangible, measurable gain that puts you on the offensive. But there is one final, absolutely critical piece of instruction. If you get this wrong, all your effort is for nothing. You can send in extra money, but if you don't tell the bank exactly what to do with it, they might not use it the way you want. Some lenders will simply apply your extra payment towards your next month's bill. So you pay an extra $500 in May, and they just reduce your June payment by $500. You've accomplished nothing. You haven't reduced the principal. You've just paid part of next month's interest early. Other lenders might put it into something called an unapplied funds or suspense account, where it just sits doing nothing until it accumulates to the amount of a full payment. This is a disaster. It neutralizes your attack completely. To ensure your strike lands, you must be explicit. When you make an extra payment, whether online or with a paper check, you must designate that the funds are to be applied directly to principal. On an online payment portal, there is almost always a separate box for extra principal payment or additional principal. Use it. If you're mailing a check, write your loan number on the check, and on the memo line, write in clear block letters, for principal reduction only. Do not leave this to chance. You are giving an order, not a suggestion. By making these small, consistent, and correctly designated extra payments, you are fundamentally changing the math of your loan. You are taking a 30-year sentence and commuting it on your own terms. You are seizing control from the lender and putting it back in your hands. We've just covered the most effective way to attack your mortgage from the outside, chipping away at it payment by payment. It's a powerful and proven strategy of financial brute force. But what if there was a way to alter the loan's very DNA? A way to make your regular payments more powerful without necessarily increasing them? There is. It's a little-known process called a mortgage recast. And it's a strategic weapon that most homeowners have no idea is even in their arsenal. And learning how to request it, when to use it, and how it can fundamentally rewrite your financial future, that is our next target. It's a simple, powerful action that recalculates your loan based on a new, lower principal balance. Think of it this way. Refinancing is like trading in your old car for a completely new one, with a new loan, a new interest rate, and a mountain of paperwork. A mortgage recast is like putting a brand new, more efficient engine in the car you already own. You keep your original loan, you keep your fantastic interest rate, but the monthly cost to run it drops dramatically. Let's make this real. Meet Mark and Sarah. 5 years ago, they bought their dream home with a $400,000, 30-year fixed mortgage at a rate of 3.5%. A great rate they'll likely never see again. Their monthly principal and interest payment is $1,796. For 5 years they've paid on time every time. Life is good. Then they receive a windfall. A combination of a work bonus and a small inheritance gives them an extra $50,000. Now they're at a crossroads. What is the smartest thing to do with this money? The traditional advice, the advice their parents would give, is to make a one-time lump sum payment directly to the mortgage principal. It's a solid, respectable move. So let's run the numbers on that. After 5 years of payments, their remaining mortgage balance is about $363,000. They take their $50,000 windfall and apply it directly to that principal. Boom! Their new balance is now $313,000. But here's the critical part. Their monthly payment of $1,796 doesn't change. The bank doesn't automatically adjust it. They are still required to pay the exact same amount every single month. So what's the benefit? The benefit is time. Because they are paying the same large payment on a much smaller balance, all that extra money goes straight to principal. Instead of having 25 years left on their loan, They've now shaved a massive 7 years and 2 months off their mortgage. They will own their home free and clear much sooner. And the interest savings? Staggering. By paying it off early, they will save over $46,000 in interest over the life of the loan. This is a fantastic outcome. It's a financially sound decision that accelerates their path to being completely debt-free. For many people, this is the goal and this is the right path. But it's not the only path. And for Mark and Sarah, who are in their mid-30s with young kids and future expenses like college tuition looming, maybe being debt-free in their late 50s isn't the only priority. Maybe what they need right now is more flexibility, more cash flow, more breathing room in their monthly budget. This is where the secret weapon comes in. This is where they choose to recast. So let's rewind. They have the same $50,000 windfall. Their balance is the same $363,000. But instead of just sending the check, they call their lender. They say the magic words. We want to request a mortgage recast. The lender charges them a small administrative fee, maybe $250. Mark and Sarah make the $50,000 principal payment, and then the bank performs the recast. The bank takes their new, lower balance of $313,000 and re-amortizes it or recalculates it over the original remaining term of their loan, which is 25 years. They keep their incredible 3.5% interest rate. And the result? Their new mandatory monthly payment drops from $1,796 down to $1,551. That is a reduction of $245 every single month. That's nearly $3,000 a year in newfound cash flow. $3,000 that is no longer obligated to the bank. $3,000 they can now control. This is the fundamental difference. The first option shortened the sentence. This option lightened the load. Now what about the interest savings? Because they are stretching the payments back out over the full 25 years, they will pay a bit more in interest compared to the first option. In this scenario, their total interest savings would be around $31,000, compared to the $46,000 they saved by paying it off early. So, yes, from a pure interest save perspective, the traditional paydown method is superior. But this is where a spreadsheet stops and real life begins. The question isn't just, how do I save the most interest? The question is, what is the most powerful and strategic way to use this money to build wealth and reduce risk? Let's look at what that extra $245 a month gives Mark and Sarah. It gives them options. It gives them power. They can take that $245 and use it to max out a retirement account. If they invested that money and got a modest 7% market return over the next 25 years, that $3,000 a year could grow to over $190,000. That single decision created a massive new pillar for their retirement. Or maybe they use it to pay off their high-interest car loan or credit card debt, saving them far more in the long run than the extra mortgage interest they're paying. Or maybe they just need the breathing room. Maybe it allows Sarah to go from full-time to part-time to spend more time with the kids. Or it gives Mark the confidence to leave his stable but soul-crushing job to start his own business. The lower payment is a safety net. It reduces their monthly financial burn rate, making them more resilient to a job loss or an unexpected medical bill. And here is the most beautiful part of the recast strategy. It gives you the best of both worlds. Just because their required payment is now lower, doesn't mean they can't still pay more. Mark and Sarah now have a mandatory payment of $1,551, but if they have a great month at work, they can still choose to pay the old amount of $1,796, or $2,000, or whatever they want. They can effectively replicate the pay-it-off early strategy whenever it suits them, without being locked into that higher payment during months when money is tight. A recast gives you flexibility without obligation. It turns a rigid financial requirement into a series of monthly choices. You get the cash flow advantage immediately, and you retain the option to pay down the principal aggressively when you can. So who is this for? A recast is an incredible tool if you have a lump sum of cash, from an inheritance, the sale of another property, or just disciplined saving. And you want to improve your monthly cash flow without losing your historically low interest rate. It's for the person who values financial flexibility and wants to put their money to work in other areas, like higher return investments or paying off higher interest debt. It's generally not the right move if your sole, number one priority is to be debt-free as fast as humanly possible. In that case, the traditional lump sum payment is your champion. It's also important to note that not all loans are eligible. Most conventional loans are, but government-backed loans like FHA and VA typically do not allow recasting. The only way to know for sure is to call your lender. The process is shockingly simple. You call the mortgage servicing department, not the sales department, and you ask if they offer a reamortization or a recast. They'll confirm your loan type is eligible, tell you their minimum lump sum requirement. It's often between $5,000 and $10,000, and outline the small fee. You send the payment with a clear letter stating your intent to recast, they process it, and within a billing cycle or two, your new lower monthly payment appears on your statement. This isn't about finding some obscure loophole. This is about understanding the mechanics of the largest debt you will ever have, and using the built-in tools to make it work for you, not against you. Most people only see two options with their mortgage: pay the minimum or refinance. But there is a powerful third path, a strategic middle ground that combines the best of both worlds. It frees up your most valuable resource, your monthly cash flow, and puts the power of choice back in your hands. But a recast is just one tool. What happens when your interest rate isn't a beautiful 3.5%? What happens when you're staring down a 7 or 8% rate, and a recast just won't move the needle enough? That's when you have to consider the heavyweight champion of mortgage strategy, a full-blown refinance. But the decision to refinance in today's volatile market is more complex and more dangerous than ever before. Choosing the right time, the right lender, and the right type of refinance can save you tens of thousands of dollars or cost you a fortune. And navigating that minefield is exactly where we're going next. Let's start with the two fundamental paths you can take, the two doors behind which your financial future lies. On one side, you have the rate and term refinance. This is the classic, the one you hear about most often. Its goal is simple and pure: to replace your existing mortgage with a new one that has better terms, usually a lower interest rate, a shorter loan duration, or both. It's a strategic move designed to save you money over the long haul. Then, on the other side, you have the cash-out refinance. This one is different. It's alluring. It lets you replace your current mortgage with a new, larger one, and you get to pocket the difference in cash. It feels like unlocking a secret vault in your own home. But this path is lined with hidden tripwires that have financially crippled countless American families. To understand the difference, let's look at two hypothetical but very real scenarios. First, meet Mark and Sarah. They bought their first home back in 2018. They scraped together a down payment, found a house they loved, and locked in a 30-year fixed-rate mortgage for $400,000 at a 4.75% interest rate. Their monthly principal and interest payment was about $2,086. For years, they paid it dutifully. It was the biggest line item in their budget, but they were building a life. Then, a few years later, interest rates across the country began to fall. They saw headlines about rates dipping below 3%. A friend mentioned they had just refinanced. Mark and Sarah started to wonder, could they do better? After some research, they found they could qualify for a new 30-year fixed-rate loan at 2.85%. They ran the numbers. Their original loan was for $400,000. After a few years of payments, their remaining balance was around $385,000. They decided to do a simple rate and term refinance for that exact amount. The result was staggering. Their new monthly principal and interest payment dropped to $1,597. That's a savings of $489 every single month. That's nearly $6,000 a year that they could now use for investing, saving for their kids' college, or just breathing a little easier. But the real magic happens when you look at the total interest paid over the life of the loan. On their original 4.75% mortgage, they were on track to pay over $350,000 in interest. With their new 2.85% loan, their total interest would be closer to $190,000. By making one smart decision, by navigating this one part of the minefield correctly, Mark and Sarah saved themselves over $160,000. That's not just a small win. That is a life-altering amount of money. This is the power of a strategic, disciplined refinance. It's using the system to your advantage. Now let's meet another couple, David and Jessica. They bought their home around the same time as Mark and Sarah. They also had a mortgage with a rate around 4.5%. But their story takes a different turn. Over the next few years, the housing market in their area went absolutely insane. Their home, which they bought for $500,000, was suddenly appraised at $750,000. They had $250,000 in home equity just sitting there. On paper, they were richer than they'd ever been. At the same time life had happened, they'd racked up about $30,000 in credit card debt between a kitchen renovation and a few unexpected medical bills. The interest rates on those cards were brutal, some as high as 22%. They were also getting mailers every week, slick, glossy advertisements from lenders. Use your home's equity. Unlock the cash in your walls. Consolidate your debt with a low-interest loan. Sounded like the perfect solution. A magic bullet. So they called a lender who painted a beautiful picture. "We can refinance your remaining $450,000 mortgage," the loan officer said. "We'll roll in your $30,000 of credit card debt, and we'll even give you another $20,000 in cash to build that new deck you've always wanted. Your new loan will be $500,000, but because rates are so low, your monthly payment will barely change. You'll be debt-free and have a new deck." Sounded too good to be true. And it was. David and Jessica had just stepped on the first, and most dangerous, tripwire in the cash-out refinance minefield. They had just converted $30,000 of unsecured debt into secured debt. This is a concept that every single homeowner in America needs to understand. Your credit card debt is unsecured. If you lose your job and can't pay your Visa bill, the credit card company can ruin your credit score, they can hound you with collections calls, they can even sue you. But they cannot come and take your house. Your mortgage, on the other hand, is secured debt. The loan is secured by the property itself. If you fail to make your mortgage payments, the bank has the legal right to foreclose and take your home away from you. By rolling that credit card debt into their mortgage, David and Jessica had just put their family's home on the line for their past Best Buy purchases and restaurant meals. They traded a financial problem for a potential homelessness problem, and they didn't even realize it. But the traps didn't stop there. The second tripwire they hit was the amortization reset. Remember, in the early years of a 30-year mortgage, the vast majority of your payment goes toward interest, not principal. You're barely making a dent in what you actually owe. David and Jessica had already paid 5 years of mostly interest payments on their original loan. By refinancing into a new 30-year loan, they reset the clock. They went right back to year one, to a new 3-decade slog of paying mostly interest to the bank. Their monthly payment might have felt similar, but the total interest they would now pay over the lifetime of this new, larger loan would be astronomically higher than if they had just stuck with their original plan and aggressively paid down the credit cards separately. The lender sold them on the monthly payment, not the total cost. And the total cost is where the banks make their fortune. The final tripwire was the illusion of wealth. They pulled $50,000 out of their home. But they didn't create money. They simply converted a piece of their ownership stake into a larger debt. They now owed $500,000 on a house they originally bought for $500,000, even though it was worth more on paper. If the housing market corrected, if prices dropped by just 10 or 15%, they could suddenly find themselves underwater, owing more on their mortgage than their home is actually worth. That equity they thought was a safety net was gone, spent on a deck and past bills. They had thinned their financial armor, leaving themselves more vulnerable to the next economic downturn. The story of David and Jessica is the story of how home equity, the American dream's crowning achievement, becomes a golden cage. Lenders love cash-out refinances because it increases the loan balance, which means more interest for them over a longer period. It's a fantastically profitable product. They are selling you access to your own money at a high price while convincing you that you're getting a deal. This isn't to say that every cash-out refinance is a mistake. If you're using the money for a high-return investment or a home improvement that dramatically increases the property's value, an argument can be made. But for the vast majority of Americans, it's used to finance a lifestyle, to pay for consumption, and in doing so, they are gambling with the roof over their heads. Understanding this distinction, the disciplined, wealth-building strategy of a rate-and-term refinance versus the seductive, risk-laden path of a cash-out refinance, is one of the most important financial lessons a homeowner can learn. It's the difference between your house being an asset that serves you, and you being an asset that serves the bank. But even for those who choose the right path, the costs don't stop there. The mortgage industry has layers of fees and required expenses that are rarely discussed in the glossy brochures. One of the most misunderstood and resented of these is a special kind of insurance you're forced to buy, not to protect you but to protect the bank from you. It's a penalty you pay for not having enough cash in the first place, and it's called private mortgage insurance. So let's unpack that. Private mortgage insurance, or PMI. It's one of the most misunderstood and resented parts of a mortgage. Imagine you walk into a bank, ready to buy your first home. You've saved for years, you've got a good job, a solid credit score, and you've managed to pull together a 10% down payment on a $400,000 house. That's $40,000 in cash. For most people, that is a monumental achievement. You feel proud, you feel ready. You sit down with the loan officer, and they tell you that because you didn't bring $80,000 to the table, a 20% down payment, you are considered a higher risk. The bank's logic, whether you agree with it or not, is simple. They believe that the less of your own money you have in the deal, the more likely you are to walk away if things get tough. If you lose your job or the housing market takes a dip, and you only have a little bit of skin in the game, you might be tempted to just stop paying and let the bank foreclose. To protect themselves from that specific risk, they force you to buy an insurance policy. But here's the kicker, the absolute gut punch of PMI. This insurance policy doesn't protect you. If you default on your loan, the insurance company doesn't pay off your house and let you keep it. No, it pays the bank to cover their losses. You are paying a monthly premium for an insurance policy that lists your lender as the sole beneficiary. It's like being forced to buy life insurance for a complete stranger. How much does this cost? It varies, but a typical range is between 0.5% and 1% of the original loan amount per year. Let's go back to our example. You're buying a $400,000 house with 10% down. That's a $40,000 down payment. So your loan amount is $360,000. If your PMI rate is, say, 0.6%, you'd calculate that on the loan amount. So, 0.006 times $360,000 is $2,160 per year. Divide that by 12, and you're looking at an extra $180 added to your mortgage payment every single month. $180 that does not go towards your principal. It does not go towards your interest. It does not build a single penny of equity in your home. It just vanishes. It's the price of admission for not having a 20% down payment. Over 5 years, that's nearly $11,000 gone. Money that could have gone towards a new roof, a kitchen renovation, your kids' college fund, or simply paying down your loan faster. Instead, it went to an insurance company to make your bank feel safe. Now, the good news is, PMI is not a life sentence. Unlike your high school yearbook photo, you don't have to be stuck with it forever. The law is on your side here, specifically a piece of legislation called the Homeowners Protection Act of 1998. This act lays out the rules for how and when you can finally break free from PMI. And there are a few ways to do it. The first way is the slow and steady automatic route. By law, your lender is required to automatically terminate your PMI on the date when your principal balance is scheduled to reach 78% of the original value of your home. So, on that $400,000 home, once your loan balance drops to $312,000, the PMI should automatically fall off. The key word there is scheduled. This is based on your original amortization schedule, assuming you make every single payment on time without paying any extra. But who wants to wait for that? You want to get rid of this fee as soon as humanly possible. And you can. The law also states that you can request to have your PMI canceled once your loan balance reaches 80% of the home's original value. That's a full 2% earlier than the automatic termination. On our $360,000 loan, that means you can petition for removal once you owe $280,000. You have to be proactive. You have to call your lender, you have to submit a written request, and you have to have a good payment history. But taking that initiative can save you months or even years of paying that extra $180. But here's where it gets really interesting, and where thousands of homeowners have saved a fortune in recent years. The 80% rule isn't always based on the original value of your home. It can be based on the current value. Think about what's happened in the housing market. Let's say you bought that $400,000 house 3 years ago. You've been paying down the mortgage, but maybe your loan balance is still around $340,000. You're a long way from that 80% threshold. But what if, due to a hot market, your house is now worth $500,000? Now the math changes dramatically. Your loan-to-value ratio is no longer your loan balance divided by the original $400,000. It's your loan balance divided by the new $500,000. $340,000 divided by $500,000 is 68%. You are now well below the 80% threshold. In this scenario, you can contact your lender and request PMI removal based on the current appraised value. They will likely require you to pay for a new appraisal, which might cost a few $100s to prove the new value. But paying $500 for an appraisal to save $180 a month is one of the best returns on investment you will ever find. This is a critical piece of financial knowledge for any homeowner with PMI. Don't just sit back and wait for it to disappear. Be an active participant. Track your loan balance and, more importantly, track your local housing market. If home values in your neighborhood are shooting up, you could be sitting on a golden ticket to eliminate a major monthly expense. Now, a crucial word of warning. This all applies to conventional loans. If you have a government-backed loan like an FHA loan, the rules are different and frankly much harsher. FHA loans have something similar to PMI, but it's called a mortgage insurance premium, or MIP. And for most FHA loans originated after 2013 where you put down less than 10%, that mortgage insurance premium is for the entire life of the loan. It never goes away. The only way to get rid of it is to sell the house or refinance into a conventional loan once you have enough equity. This is a devastatingly expensive detail that many first-time buyers using FHA loans don't realize until it's too late. It's a trade-off. FHA loans are easier to qualify for, but that long-term cost of MIP can be astronomical. So we've dissected principal, the money you borrowed. We've untangled interest, the price of borrowing it. And now we've exposed this extra layer of insurance, the penalty for a low down payment. You might be thinking, okay, that's it, right? Principal, interest, and this occasional PMI thing. That's the whole payment. But we've only covered the PI and another I. The full, common acronym for a mortgage payment is PITI. We still have to talk about the T and the other I. These are two more costs, two more mandatory payments bundled into your monthly bill that have absolutely nothing to do with paying back the bank. They are payments you can't escape, they can change without your permission, and they will follow you for as long as you own your home. We're talking about property taxes and homeowners insurance, and they are siphoned into a special holding account, managed by your lender, called an escrow account. This account is the lender's way of making sure the most important bills associated with your house get paid on time, every time. Because if they don't, the lender's investment, your home, is at risk. Think about it from their perspective. They've loaned you hundreds of thousands of dollars. They have a lien on your property, meaning if you stop paying your mortgage, they can foreclose and take the house to recoup their money. But there's one entity that can jump ahead of them in line. One creditor whose power is absolute: the government. If you fail to pay your property taxes, the local county or municipality can place a tax lien on your home. And a tax lien is a super lien. It takes priority over all other liens, including the bank's mortgage. This is the lender's worst nightmare. They could foreclose on a home only to find that it has a massive, unpaid tax bill attached that they are now responsible for, or worse, that the county is seizing the property for a tax sale. The same logic applies to homeowners insurance. If your house burns down and you let your insurance policy lapse, the bank's collateral, the asset securing their massive loan, literally goes up in smoke. It becomes worthless. So the lender isn't willing to trust you with these critical payments. They force you to pay them through you by creating the escrow account. It's a non-negotiable term for most loans, especially if you put down less than 20%. Here's how it works. When you close on your home, the lender does some math. They get an estimate of what your property taxes will be for the entire year. Let's say it's $6,000. Then they get a quote for your homeowner's insurance premium for the year. Let's say that's $1,200. They add those together. That's a total of $7,200 in essential non-mortgage expenses for the year. Then they do the simple division. $7,200 divided by 12 months is $600 per month. This $600 is your monthly escrow payment. It gets tacked right onto your principal and interest payment. So if your P&I was $2,000, your new total monthly payment, often called the PITI, principal, interest, taxes, and insurance, is now $2,600. You write one check to your lender for $2,600, and they take care of the rest. They put the $2,000 toward your loan and deposit the $600 into your escrow account. When those big property tax and insurance bills come due, the lender pays them on your behalf, using the money you've been setting aside in that account all year. In theory, it's a simple, convenient system, a kind of forced budgeting that prevents you from getting hit with a surprise $6,000 tax bill you might not have saved for. It automates the process. But here's where it gets complicated, and where millions of homeowners get a nasty surprise every single year. First, the lender isn't just collecting exactly what you owe. Federal law allows them to keep a cushion in your escrow account. This cushion is typically equal to 2 months' worth of escrow payments. In our example, that's an extra $1,200. They do this to cover any unexpected increases in your taxes or insurance premiums. So, from day one, you're forced to park an extra chunk of cash in an account that you don't control and, critically, that earns you zero interest. It's your money just sitting there, benefiting the lender's stability. But the real gut punch comes once a year, during something called the annual escrow analysis. This is when your lender looks back at the past year and reconciles the account. They compare what they thought your taxes and insurance would be with what they actually were. And then they project what those costs will be for the next year. After this analysis, one of two things happens: you have a shortage or you have an overage. Let's talk about the shortage because it's the scenario that causes the most financial pain. Imagine you get a letter in the mail from your mortgage company. You open it, and it's your annual escrow statement. It says that last year, your property taxes didn't stay at $6,000. The county reassessed your home's value, and your tax bill actually went up to $6,600. On top of that, due to inflation or a recent claim in your area, your homeowner's insurance premium rose from $1,200 to $1,500. The lender paid these higher bills for you out of the escrow account. But now the account is short. It doesn't have enough money. In this case, you had a $600 tax increase and a $300 insurance increase. That's a $900 shortage for the year. Now you have to pay that back. The lender will give you two choices, neither of them great. Option 1. Write them a check immediately for the full $900. For many families, coming up with an unexpected $900 payment is a huge burden. Option 2. The lender will spread that $900 shortage over your next 12 monthly payments. That's an extra $75 a month. But wait, gets worse. The pain doesn't stop there. The lender doesn't just need you to pay back the old shortage. They have to adjust your payment for the new higher costs going forward. Your new annual tax and insurance total is now $8,100, not $7,200. Divide that by 12 months, and your new base escrow payment is $675, up from $600. So let's add it all up. You have your old P&I payment of $2,000. You have your new higher escrow payment of $675. And you have the $75 per month to make up for last year's shortage. Your new total monthly mortgage payment has just jumped from $2,600 to $2,750, a $150 a month increase. This is called payment shock, and it happens to homeowners across the country every single day. It feels like your mortgage went up, but your loan itself didn't change. It was the parasitic costs, the taxes and insurance you have no direct control over, that swell, dragging your required payment up with them. Occasionally, the opposite happens. You might have an escrow overage. Maybe your county lowered the tax assessment, or you shopped around for cheaper insurance. If the lender collected more money than they needed to pay out, they have to return it to you. You'll get a surprise check in the mail for the surplus amount. It feels like a bonus, a little windfall. But remember, it's not free money. It's your own money that was sitting in their account, earning nothing, being returned to you. Now, for many homeowners, especially those who made a smaller down payment, there's a fifth letter that can haunt that pity acronym, turning it into PISHA. This stands for association dues, like an HOA. But more commonly, there's a different, more dreaded cost: PMI, private mortgage insurance. PMI is another mandatory expense, but it's one of the most misunderstood parts of a mortgage. It is an insurance policy that you pay for, but it protects the lender, not you. If you put down less than 20% on a conventional loan, the lender sees you as a higher risk. If you default on the loan and they have to foreclose, they might not be able to sell the house for enough to cover the entire loan balance. PMI is there to cover that potential loss for the lender. It's their safety net, and you're forced to pay the premiums. This PMI premium, which can be hundreds of dollars every month, is typically rolled into your escrow payment as well. So that $600 a month in our example could easily be $800 or $900 once PMI is factored in. It's another charge siphoned out of your bank account every month that does nothing to build your equity or pay down your loan. It's purely the cost of entry for not having a large down payment. So you're trapped. You have property taxes that can rise without your consent, insurance premiums that fluctuate with the market, and for many, a PMI payment that feels like you're just throwing money away. All of these are collected by your lender, who can change your total monthly payment once a year, leaving you to scramble and adjust your budget. It can feel like you're not in complete control of your biggest monthly expense. It begs the question, is there a way out? Can you ever escape this system? Can you fire your lender as your bill collector and manage your own taxes and insurance? Can you kill that PMI payment forever and reclaim hundreds of dollars a month? The answer is yes. But it isn't automatic, and you have to fight for it. And that fight is exactly what we're breaking down in the next part. Let's start with the low-hanging fruit, the parasitic fee that tens of millions of Americans are paying every single month: private mortgage insurance, or PMI. This is the fee the lender forces you to pay for their protection, not yours. It's insurance you pay for in case you default so the bank doesn't lose money. And they will let you keep paying it forever if you don't know your rights. But you have a powerful weapon on your side. A federal law called the Homeowners Protection Act of 1998. This law gives you the legal right to kill your PMI. The law basically sets up two major milestones based on your loan-to-value ratio, or LTV. That's just a fancy way of saying the percentage of your home's original value that you still owe. If you bought a house for $200,000 and your loan is $160,000, your LTV is 80%. This number is your key to freedom. The first milestone is your right to request cancellation. The moment your mortgage balance is scheduled to reach 80% of the original value of your home, you can officially ask your lender to terminate your PMI. You can't be late on your payments, and you have to make the request in writing. Now, the lender might fight back a little. They can require you to prove that the value of your home hasn't declined. This often means you'll have to pay for a new appraisal, which could cost anywhere from $300 to $600. And this is where people get stuck. They think, why should I pay $500 just to save $150 a month on PMI? Let's do the math. Paying $500 one time to save $150 every single month means you break even in less than 4 months. After that, every single $150 payment you don't make is pure savings straight back into your pocket. That's $1,800 a year. It is almost always worth it. You are fighting for your own money. But what if you don't want to fight? What if you just keep making your payments? Well, the law has a safety net for you. This is the second milestone: automatic termination. The law mandates that your lender must automatically cancel your PMI on the date your loan balance is scheduled to reach 78% of the home's original value. 78%, not 80%. That 2% difference is the bank's gravy. It's months, maybe even a year or more, of extra PMI payments they get to collect from you simply because you didn't pick up the phone and fight for it at the 80% mark. Don't give them that satisfaction. Track your loan balance. Know your numbers. The day you hit 80%, send that certified letter. There's a massive exception here, a trap we have to talk about: FHA loans. If you have an FHA loan, the rules are completely different and frankly much worse. For most FHA loans taken out after June 2013, if you put down less than 10%, you are required to pay their version of PMI, called the Mortgage Insurance Premium or MIP, for the entire life of the loan. It never goes away. It doesn't matter if you have 50% equity or if the house is completely paid off in 30 years, that MIP payment is permanent. The only way to get rid of it is to refinance out of the FHA loan and into a conventional mortgage once you have enough equity. This is a critical piece of information that millions of FHA borrowers don't realize until years down the road. So you fought the battle, you've used the law, and you've successfully slain your PMI. You've just reclaimed a significant chunk of your monthly payment. But we're not done. Look at your mortgage statement again. We've dealt with the M, the mortgage insurance. Now let's talk about the T and the I, taxes and insurance. Specifically, the escrow account that holds the money for them. An escrow account is a special savings account managed by your mortgage lender. Every month, a portion of your mortgage payment is diverted into this account. Then, when your property tax bills or homeowner's insurance premiums are due, the lender pays them on your behalf from the funds in that account. On the surface, it sounds convenient. It's a forced savings plan that ensures you don't get hit with a massive, unexpected $5,000 tax bill. The bank is just helping you budget, right? Wrong. An escrow account is another mechanism of control. The bank is holding your money, often thousands of dollars, in an account that typically pays you zero interest. They, on the other hand, get to use that massive pool of capital. Furthermore, they often miscalculate. They might collect too much, resulting in an escrow surplus they have to refund you at the end of the year. More often, they collect too little, especially if property taxes go up. This creates an escrow shortage, and your monthly mortgage payment suddenly jumps up to cover the difference and build the reserve back up. You've probably heard friends complain about this. My mortgage just went up $300 a month out of nowhere. It's almost always an escrow miscalculation. You can take back control. You can fight to close your escrow account. This means you would be responsible for paying your property taxes and homeowner's insurance premiums yourself, directly. Instead of pity, your monthly payment to the bank would just be P&I, principal and interest. The money for taxes and insurance would go into your bank account instead of theirs. Why would you do this? 3 reasons. First, control. It's your money. You should decide where it sits. Second, interest. Instead of letting that money sit in the lender's no-interest account, you can put it in your own high-yield savings account and earn interest on it all year long. It might not be a fortune, but it's not zero. It's your money working for you, not for them. Third, accuracy. You will never have a surprise escrow shortage again because you are managing the funds. You see the tax bill come, you see the insurance premium, and you pay it. No middleman, no miscalculations. So how do you do it? The rules for removing escrow are not set by federal law like PMI. They are set by the lender and the loan type. Generally, most conventional loans will allow you to waive escrow once you reach a certain level of equity, typically 20%, the same 80% LTV we talked about for PMI. You'll need a perfect payment history, and just like with PMI, you'll need to make a formal written request. Again, they won't offer this to you. You have to ask for it. You have to demonstrate that you are a responsible borrower. Now, a very important warning. This strategy is not for everyone. If you choose to manage your own taxes and insurance, you take on all the responsibility. If you forget to pay your property taxes, the county can put a lien on your home and eventually foreclose. If you forget to pay your homeowner's insurance and your house burns down, you are left with a mortgage on a pile of ash. You absolutely must be disciplined. You have to treat that money you're saving as untouchable, earmarked only for those two big, predictable expenses. You must set calendar reminders, automate transfers to a separate savings account, and be your own financial manager. But if you have that discipline, the rewards are immense. By killing PMI and closing your escrow account, you fundamentally change your relationship with your lender. You are no longer just sending them a single opaque pity payment every month. You are now only sending them their due, the principal and interest on the money you borrowed. The rest, the governance of your home's major expenses, is back in your hands. You've simplified your mortgage and taken a massive step toward financial sovereignty. You've taken the power back. But there's an even bigger lever you can pull. One that can fundamentally alter the entire financial equation of your loan, potentially saving you not just hundreds, but thousands of dollars a year and tens of thousands over the life of the loan. It's the single most powerful tool a homeowner has to fight back against high debt costs. And it all comes down to one single number: your interest rate. And bending that number to your will is an art form we need to break down. So how do you do it? How do you seize control of this one all-powerful number? The first and most famous strategy is the financial equivalent of hitting a reset button: refinancing. Refinancing is simply taking out a new loan to pay off your existing mortgage. The goal is to replace your old, clunky, expensive loan with a new, sleeker, cheaper one. The most common reason people do this is to lock in a lower interest rate when market rates have dropped. Think about it. If you bought your house when rates were at 7%, and a few years later they've fallen to 5%, you're essentially overpaying by 2% every single month. Refinancing allows you to trade in that 7% loan for a 5% one. Let's put that into perspective. On a $400,000 mortgage, dropping your rate from 7 to 5% isn't just a minor tweak. It's a financial earthquake. That single move could slash your monthly payment by nearly $500. Over the life of the loan, that's a staggering $175,000 that stays in your pocket, not the bank's. That's a college education. That's a comfortable retirement. That's freedom. All from one strategic move. But refinancing isn't just about chasing lower rates. It's a multi-tool. Some homeowners refinance from a 30-year loan into a 15-year loan. Their monthly payment might go up, but they'll be debt-free decades sooner and save an astronomical amount in interest. Others use a cash-out refinance. This is where you borrow more than you owe on your current mortgage and take the difference in cash. People use this to consolidate higher interest debt, like credit cards, or to fund a major home renovation. It's a powerful option, but a dangerous one if not handled with immense discipline. You're turning unsecured debt into secured debt, putting your home on the line. The key question is always, when does it make sense? You'll hear a rule of thumb, something like refinance if you can lower your rate by at least 1%. But frankly, that's lazy advice. The real answer is all about the break-even point. Refinancing isn't free. You have to pay closing costs just like you did when you first bought the house. These can be thousands of dollars. You need to calculate how long it will take for your monthly savings to cover those costs. If your closing costs are $5,000 and you're saving $200 a month, your break-even point is 25 months. If you plan on staying in the house for at least another 2 or 3 years, it's a fantastic move. If you might sell in a year, you'd lose money. It's always about the math. But what if market rates aren't dropping? Are you just stuck? Absolutely not. Because the market rate is only half the equation. The other half is you. The interest rate a lender offers you is, at its core, a reflection of how risky they think you are. The less risky you appear, the better your rate. And your risk level is quantified by a handful of critical numbers, chief among them, your credit score. Your credit score is not a grade on your character. It's a trust score. It's a lender's quick, data-driven answer to the question, if I lend this person a massive amount of money, what are the odds they'll pay it back on time? A score of 760 or higher tells them you're a sure bet. A score below 640 makes them nervous, and they'll charge you a premium, a higher interest rate, to compensate for that perceived risk. The difference between an excellent credit score and a fair one can mean a difference of over a full percentage point on your mortgage rate. On that same $400,000 loan, that's a $60,000 poor credit tax you'd pay over the life of the loan. So, how do you master this score? You have to understand what it's made of. 35% of your FICO score is your payment history. It's the king. One late payment can linger on your report for 7 years, acting as a constant drag on your score. The single most important thing you can do for your financial health is to pay every single bill on time, every single time. Set up autopay. Put reminders in your phone. Do whatever it takes. The next 30% is your credit utilization ratio. This is the amount of revolving credit you're using compared to the total amount you have available. If you have a credit card with a $10,000 limit and you have a $3,000 balance, your utilization is 30%. Experts recommend keeping this below 30%, but the real pros, the people with 800+ scores, keep it below 10%. High utilization signals to lenders that you might be overextended and relying on debt to live, which is a major red flag. Paying down your credit card balances is one of the fastest ways to give your score a significant boost before applying for a mortgage. 15% is the length of your credit history. This is about stability. Lenders like to see a long, proven track record. This is why you should think twice before closing your oldest credit card account, even if you don't use it much. That card acts as an anchor for your credit history. The remaining chunks are your credit mix, showing you can handle different types of debt, like a car loan and a credit card, and new credit inquiries. Every time you apply for new credit, it can cause a small temporary dip in your score. That's why you should never go on a credit application spree right before you want to get a mortgage. Lock it down. Don't apply for a new store card, don't finance a new car. Don't do anything that makes it look like you're suddenly desperate for credit. Beyond your credit score, lenders zoom in on two other crucial ratios. The first is your loan-to-value ratio, or LTV. This is simple. It's the size of your loan compared to the appraised value of the home. If you're buying a $500,000 house and you put down $100,000, you're borrowing $400,000. Your LTV is 80%. The lower your LTV, the better. A low LTV means you have more skin in the game, more equity. From the lender's perspective, if you have a huge chunk of your own money tied up in the house, you're far less likely to walk away in default. This is why a 20% down payment is the gold standard. It gets you an 80% LTV, which not only helps you secure a better rate but also allows you to avoid private mortgage insurance, or PMI, that extra monthly fee we talked about. The second is your debt-to-income ratio, or DTI. This is the ultimate stress test. It measures what percentage of your gross monthly income goes toward paying your monthly debt obligations. This includes your potential new mortgage payment, property taxes, insurance, plus car payments, student loans, and minimum credit card payments. Imagine your monthly income is a bucket. Lenders want to see how full that bucket already is before they pour a giant mortgage payment into it. Most lenders draw a hard line around 43%. If more than 43% of your pre-tax income is already spoken for, getting approved for a loan becomes incredibly difficult. Keeping your DTI low by paying down other loans and avoiding new debt before you apply is absolutely critical. Armed with this knowledge, a strong credit score, a low DTI, and a solid LTV, you are no longer a passive participant. You are an A-list borrower. And A-list borrowers have the ultimate power, the power of choice. You must never, ever take the first offer a lender gives you. This isn't like buying milk at the store where the price is fixed. Mortgage rates and fees are negotiable. You need to shop around. Get official loan estimates from at least 3 to 5 different lenders, big banks, local credit unions, and online mortgage brokers. When you get these standardized forms, you can compare them apples to apples. Look at the interest rate, of course, but also scrutinize the fees in Section A, the origination charges. See if one lender is charging points, prepaid interest to buy down the rate. Sometimes it's worth it, sometimes it isn't. You can then take the best offer and go back to the other lenders. Can you beat this? You ask. You would be absolutely shocked at how often they can. A little bit of negotiation, a little bit of competition between lenders can save you thousands. You are the prize. You are the customer they want. By mastering these numbers and leveraging competition, you transform from a rate taker into a rate maker. You are bending the system to your will. You are taking control. And this individual power, when multiplied by millions of households across the country, doesn't just change personal fortunes. It begins to shape the very fabric of the national housing market, creating ripples and reactions that will define the future of homeownership in America. And what does that future look like? For decades, the American dream was a postcard image. A single-family home, a two-car garage, a manicured lawn. But the numbers we've explored, the soaring prices, the crushing debt loads, the stark reality of interest rates, are forcing a nationwide rewrite of that dream. This isn't a story of failure. It's a story of adaptation. We are standing at a crossroads where the very definition of home is being reimagined out of necessity and ingenuity. The first major ripple is the affordability crisis, which is fundamentally altering demand. For millions, the math simply doesn't work anymore. A median-priced home is out of reach for a median-income family in a vast majority of the country. This isn't a market fluctuation. It's a systemic shift. In response, we're seeing a quiet revolution in living arrangements. The demand for smaller, more efficient housing is exploding. Tiny homes, once a niche curiosity, are now a viable path to ownership for some. Accessory dwelling units, or ADUs, think backyard cottages or garage apartments, are being legalized in cities across the nation, not just as rental income sources, but as primary residences for family members, creating multi-generational compounds that harken back to an older way of life. This leads to the second ripple, the changing family structure. The nuclear family, once the bedrock of suburban planning, is no longer the only model. We see more single individuals buying homes, more unmarried couples pooling resources, and a significant rise in multi-generational living. Children are staying home longer to save, and elderly parents are moving in with their adult kids to share costs and care. The 30-year mortgage was designed for a 20th century life script. Today's reality requires more flexible, creative financing solutions to match these more complex, blended household economies. The third and perhaps most powerful ripple is the generational divide. Baby boomers, who largely benefited from decades of wage growth and affordable housing, are now sitting on trillions of dollars in home equity. Many are aging in place, holding on to larger homes that might otherwise enter the market for younger families. Meanwhile, millennials and Gen Z are facing a brutal combination of high student loan debt, stagnant real wages relative to inflation, and the most expensive housing market in history. They are the digital native generations, and their approach to this crisis is fundamentally different. They are leveraging technology in ways previous generations never could. This brings us to the technological transformation of real estate. The old model of finding a realtor and flipping through binders is gone. Today's buyers are armed with apps that provide instant property valuations, crime statistics, and school ratings. Mortgage applications that once took weeks of paperwork can now be started with a few taps on a smartphone. Fintech companies are challenging the big banks, offering innovative loan products, fractional ownership models, and rent-to-own programs designed for those with non-traditional credit histories or smaller down payments. This technological arms race is democratizing information and, slowly but surely, chipping away at the old gatekeepers of the industry. It's putting more power into the hands of the consumer, but it also demands a higher level of digital and financial literacy to navigate effectively. Beyond technology, we are seeing a fundamental shift in geography. The pandemic accelerated a trend that was already simmering: the decoupling of work from a specific location. The rise of remote work means that for a growing segment of the population, the daily commute is no longer the anchor for their housing decision. People are leaving high-cost coastal cities like San Francisco and New York for more affordable mid-sized cities in the Sun Belt and the Midwest. This great relocation is creating housing booms in places like Boise, Austin, and Raleigh, but it's also pricing out longtime local residents, exporting the affordability crisis to new corners of the country. It's a complex migration pattern that is redrawing the economic and cultural map of America. So where does this leave us? Facing this complex web of economic pressure, generational shifts, and technological disruption, It can be easy to feel powerless. But the entire purpose of understanding these numbers, of dissecting this system from the ground up, is to find your power within it. The future of homeownership in America will be defined by three key principles: flexibility, knowledge, and discipline. Flexibility means letting go of the outdated, one-size-fits-all postcard of the American dream. Your path to stability and wealth building might not involve a picket fence. It might be a duplex where you live in one unit and rent out the other. It might be a co-housing arrangement with friends. It might mean buying a piece of land and building something small and sustainable over time. The dream isn't about the shape of the house. It's about the security and freedom it provides. Being flexible and open-minded to what home can be is your single greatest asset in a constrained market. Knowledge is your shield. For decades, the mortgage process was intentionally opaque, a confusing labyrinth where you were told to just sign on the dotted line. That era is over. You now have the tools to understand your credit score inside and out, to shop for mortgage rates from dozens of lenders in an afternoon, to calculate the total cost of ownership beyond the simple monthly payment. You have to do the work. You have to read the fine print. You have to understand what an ARM is, what PMI is, what closing costs are. Becoming an expert on your own financial life is no longer optional. It is the absolute prerequisite for success. And finally, discipline. This is the oldest, simplest, and most difficult principle. It's the discipline to save aggressively for a down payment, even when it feels impossible. It's the discipline to get your consumer debt under control before you even think about taking on a mortgage. It's the discipline to buy a home you can comfortably afford, not the one the bank says you can afford. In a culture that glorifies instant gratification and living on credit, the disciplined individual who plays the long game will always win. Your greatest financial asset is not your income. It's your habits. The story of mortgage debt in America is more than just a collection of statistics. It is the story of our aspirations, our struggles, and our relentless pursuit of a place to call our own. The numbers are daunting, the challenges are real, but they are not insurmountable. By understanding the system, by adapting our dreams to reality, and by taking radical ownership of our financial education, we can navigate this new landscape. The house is just the asset. The mortgage is just the tool. The real goal is to build a life. And that is a project you have complete control over starting today.